This talk is by Dr. Xiao Qiao. Xiao is a researcher at SummerHaven Investment Management. He sits on the editorial board of the Journal of Portfolio Management. His research has been featured in Forbes and Institutional Investor journals and won a Best Paper Award at R Finance 2016. Prior to SummerHaven, Xiao built predictive models forecasting the stock market at Hull Investments and has worked in Morgan Stanley's Wealth Management division. Xiao received a BS in Economics from the Wharton School and a BS in Engineering from the School of Engineering and Applied Sciences at the University of Pennsylvania, graduating summa cum laude in both. He received a finance PhD from the University of Chicago, where he was Eugene Fama's teaching assistant.
Average returns. But in fact, is there feedback? But in fact, I'm not doing that, I promise. The theoretical foundations behind this relationship goes back much further. From the days of Markowitz, he states that investors are only compensated for systematic risk. That is, in the Markowitz world, in which investors are perfectly diversified, there is no role for idiosyncratic volatility to play in cross-sectional asset pricing. So there should be zero relationship between idiosyncratic vol and average returns. But Merton gave a counterargument in his 1987 presidential address to the American Finance Association, where he asserted that idiosyncratic risk should be priced if investors are under-diversified. That is, in the Merton world, investors, for whatever reason, unlike the Markowitz world, is not perfectly diversified for maybe some frictions, so that there is a role for idiosyncratic volatility to play in asset pricing. So we follow the research agenda laid out by these researchers and also study idiosyncratic volatility. Our research question is as follows. What accounts for the common factor structure that we observe in idiosyncratic vol? There are two potential contributors towards this commonality. First, there could be co-movement in the expected component of time-varying volatility, time-varying idiosyncratic vol, that is, which would, of course, imply a common factor structure in idiosyncratic vol. The second potential contributor is that even if the time-varying expected component of volatility were constant over time, if securities A and B tend to receive volatility shocks at the same time, that would also imply a common factor structure in idiosyncratic vol. And the goal in this paper is to understand the relative importance of this time-varying volatility component versus this correlated volatility shocks component. Specifically, are both of these important in describing the data, and which one of these is priced in the cross-section of stock returns? So what we do is first, we document correlated volatility shocks are an important source of co-movement that we observe for idiosyncratic volatility. That is, the expected component of time-varying volatility is not sufficient to explain the commonality that we observe in the data. Motivated by this finding, we proposed a statistical model to capture the commonality in idiosyncratic vol. It's a multivariate Garch model that we'll call the dynamic factor correlation model. And I'll show that it fits characteristics portfolios better compared to Engel's workhorse dynamic conditional correlation model or Engel and Kelly's dynamic echo correlation model. The DFC model has a closed form likelihood, which makes it very easy to estimate, even for a large cross-section of stock returns. And it's also closely related, under certain parametric restrictions, to Boleslev's constant conditional correlation and Engel and Kelly's dynamic echo correlation. To illustrate the usefulness of the DFC model, we will conduct an exercise in portfolio optimization. We'll construct mean variance portfolios using different covariance estimates from these different volatility models that we consider. And we'll compare and show that the DFC model outperforms the unconditional covariance matrix, as well as the dynamic echo correlation covariance, in that it achieves both higher Sharpe ratios and more stable mean variance portfolios. Lastly, I'll talk about the asset price implications of the components of idiosyncratic vol. This common component in idiosyncratic volatility that was first investigated by Herskovic et al. Can be decomposed into a correlated volatility shocks factor VIN, and a time-varying volatility factor, TVV. And I'll show that VIN, this correlated volatility shocks factor, is priced in the cross-section of stock returns, and it results in an average return spread of about 3.3% per year, whereas time-varying volatility is only weekly priced, resulting in about a 1.6% spread. I'll also do double portfolio source based on these and show that neither of these subsumes the other. And double source based on these characteristics and market equity shows that it's not subsumed by the size effect. The data we consider is fairly standard. It's daily and monthly data from Ken French's websites, including the Fama-French 3 and 5 factors, as well as portfolios formed on various characteristics, including market equity, book to market, and so on. Daily and monthly stock returns, prices and shares outstanding, are from CRISP from the University of Chicago. The Chicago Fed National Activity Index to track the macro conditions and its sub-indexes are from the Chicago Fed. And it's a little cut off on the bottom here. The Aruba-Debo-Scotty Business Conditions Index is another measure of the macro conditions. It is from the Philly Fed. The Federal Reserve Bank of Philadelphia. Sorry, is there any way to get the bottom piece of this? There's like half a table missing here, actually.
I think there's a bar on the right of the screen. Projector, I think. Oh, I don't know. Yeah, they might be the projector. Oh, yeah.
Okay.
That's interesting.
Okay, that's fine. Okay. So as a first step to understanding the relative importance of correlated volatility shocks versus time-varying volatility, we'll look at these characteristic sorted portfolios. We'll fit factor models for mean returns. Here we'll use the Fama-French 3-factor model. And then we'll fit gauge models to the idiosyncratic component returns that's left over. The gauge models are going to capture time-varying volatility. And for these, if we think time-varying volatility is a sole contributor towards the commonality in idiosyncratic vol, then what we should expect to see is that these gauge innovations, free from time-varying volatility effects, should be cross-sectionally uncorrelated. So that forms our null hypothesis. In fact, what we see is that these gauge residuals are not autocorrelated, meaning that these are well-specified gauge models, but they are indeed cross-sectionally correlated. Here's a table of summary stats of the off-diagonal correlations of these gauge residuals on the idiosyncratic returns. And we see that the average correlation, rather than being 0, as we would expect if everything is driven by time-varying volatility, is about 10 to 30%. The range is quite large, and sometimes the correlations are as high as 50%. On the bottom panel here are double-sorted portfolios, and we see a similar pattern, that the average correlation is not quite 0. It's about 10 to 20%. And sometimes the correlations, the point estimates are as high as 70%. So it doesn't appear to be the case that time-varying volatility alone is sufficient to explain the degree of co-movement that we observe in idiosyncratic vol. And it's evident that these volatility shocks from the gauge models are correlated in the cross-section. And this is going to be the central fact that I'll try to explore in this paper. So the fact that we've seen so far is that these idiosyncratic volatility innovations are correlated in the cross-section. However, our existing multivariate gauge models, our volatility tools, do not necessarily account for these correlated volatility shocks. For example, the multivariate gauge workhorse model is Engel's dynamic conditional correlation, which is designed to capture time-varying correlations as well as time-varying volatility. But as I'll show you in just a few slides, it actually misses this important fact in correlated volatility shocks in the idiosyncratic volatility, which actually is a small weakness to this model. So we'll propose a new multivariate gauge model, enriching the multivariate gauge toolbox to directly model correlated volatility shocks. So we'll call this a dynamic factor correlation model. And we'll start with a standard factor model with gauge volatility. That is, returns are driven by some common factors F's with factor loading beta. And A is the idiosyncratic component of returns left over from the factor models. That's going to follow a Garch model. So HI is the conditional variance of the idiosyncratic component of returns. And E is the standardized residuals, following the literature, is given as these idiosyncratic returns scaled by the conditional volatility. Now, the innovation here is to directly impose a factor structure on these standardized residuals. We're going to rewrite these as the ratio of Q over S, in which Q itself is going to follow some factor structure here. And the common factor in idiosyncratic volatility shocks is going to be this V variable with factor loading C. And S is simply some scaling factor. So it's going to be this, what's going to be key for this model is this common factor in idiosyncratic volatility shocks, which is going to have time-varying volatility itself. And for estimation purposes, we'll impose that this is going to be a cross-sectional average of the square standardized residuals. So how do the correlations look like under this model? Recall that Q are the new pieces out of the standardized residuals that follow a factor structure. So let big Q denote the conditional variance covariance matrix of the small q's. And we see that big Q, this covariance matrix, is driven by two parts. The first part is going to be a diagonal matrix with its diagonal elements given by 1 minus C. C is the factor loading on the common factor. But what's interesting is this piece, the off diagonal, is going to be driven solely by this common factor in idiosyncratic volatility shocks. HV at T is the conditional variance of that common factor. And it's multiplied by an outer product given all the off diagonal elements. Now Q is not a correlation matrix, it's a covariance matrix. So to get the correlation matrix of the standardized residuals, we'll have to rescale this by some Q tilde, which is going to inherit the diagonal elements, but has zeros on its off diagonals. So this quadratic form, Q tilde Q times Q tilde, is the correlation matrix of the standardized residuals. Now our DFC model is closely related to other multivariate Garch models. I think the easiest way to see this is through the correlation matrix. So suppose we impose the restriction that the common factor in idiosyncratic volatility shocks were homostochastic, so that its conditional variance is 1 at each point in time. Then immediately following the previous slide, we can see that the time-varying correlation matrix reduces to the time-invariant correlation matrix with 1 on its diagonal, and just a cross product of factor loading, Ci, Cj on the off diagonal. Then the conditional covariance matrix of the idiosyncratic component of returns is given by D times R times D, in which D is this diagonal matrix with the conditional volatilities, and R is this time-invariant correlation matrix. And this is precisely Boleslev's constant conditional correlation model. Suppose we impose a different restriction, so throw this one out, that all the factor loadings on this common factor in idiosyncratic volatility shocks were equal in the cross-section. All the C's are the same. Then we still have a time-varying correlation structure, but it's driven by just a single parameter, this rho T parameter, which of course is a function of the equal factor loadings. But more importantly, notice that this HVT shows up again. That's the conditional variance of the common factor in idiosyncratic volatility shocks. Again, it's that new common factor that drives the correlation in the cross-section. And the fact that the pairwise correlations here are all the same, are all rho T, makes this exactly what Engel and Kelly's dynamic equicorrelation model implies. In order to estimate the DFC model, we'll proceed with a quasi-maximum likelihood approach. We'll assume that the innovations to this model are all normally distributed, and we'll write out the likelihood. So assuming that is the case, so the advantages of doing a QMLE is that even if the model were misspecified, you still get consistent estimates. But of course, if the model is misspecified, you don't get efficiency. So assuming that the errors are normal, here's the log likelihood of the model. And conveniently, we can decompose it into two components. This first term, which I'm calling LV of theta, is solely a function of the univariate volatility parameters, whereas the second piece is a function of both the volatility and correlation parameters. So then we can proceed with a two-step approach, which guarantees that we get the global maximum, is to first find the volatility parameters to maximize the first piece. That's only a function of volatility parameters. Then use the optimized parameters here, theta hat, in the second piece, and get phi hat for the correlation parameters. So in the end, this theta hat, phi hat set gives you the optimized parameters. Now, why do we need a new model? I've mentioned that Engel's dynamic conditional correlation is able to capture time-varying correlation, but not quite these correlated volatility shocks. Now I'll show you this first through a simulation and then empirically. So as we saw earlier, these characteristic sorted portfolios contain correlated volatility shocks. So here for my simulation exercise, I'll assume that the underlying data generating process contains correlated volatility shocks. And I'll simulate either for 3 or 10 assets and 1,000 or 5,000 time periods, as well as different combinations of these factor loadings on the common factor in idiosyncratic vol. We'll compare the DFC model with the DCC model. And the metrics we'll use are root mean squared error and mean absolute error for the fit of these models. Now, for all 6 different panels and various parametric values, we see that the DFC model consistently achieves lower root mean squared error and mean absolute error compared to the DCC model, and sometimes up to 20–30% lower for a significant improvement. So it's clear that Engel's DCC is not able to capture the common component in idiosyncratic vol shocks when they're present in the data, whereas our DFC model is designed to do so. We can also make this comparison empirically by looking at these characteristic sorted portfolios again. So here's a table of likelihood values for the DFC, the DCC, as well as Engel and Kelly's dynamic equicorrelation model, DECO on the bottom. And we see that for these portfolios, the DFC model consistently generates the highest value for the likelihood compared to the DCC or DECO models, indicating superior statistical fit. And perhaps this is not a surprise, given that at the beginning of the presentation, I showed you that for these portfolios, we indeed observe correlated volatility shocks, which is a salient fact, a feature in the data that the DCC and DECO models are not designed to capture and cannot, whereas the DFC model does. We'll also consider an extension to the DFC model, imposing a group structure for the model to be even more parsimonious and to reduce the number of estimated parameters for efficient estimation and potential better out-of-sample properties. So specifically what we do is we'll impose equal factor loadings C's within these groups and different loadings across groups. So if you have K groups among N assets, then within group K, all the factor loadings are some CK bar, call it, and that CK bar can vary from K to K. Now in the extreme case that when we have one group, all the factor loadings are the same in the cross-section, and we're back to the case of Engel and Kelly's dynamic equicorrelation. We fit the group DFC model on these characteristic sorted portfolios again, and here's what we get. These are the different groups, and we have the Bayesian information criteria on the bottom. And we see that across the groups, the group DFC model, in fact, results in lower BIC values compared to the DFC model, indicating that these may actually fit better out of sample. But the drawback is that it's not clear what these groups are. If we look at the market equity deciles, the size portfolios, we see that deciles 1 and 2 are grouped together, and 7 and 8 are grouped together, but the other ones are on their own. Whereas for the value portfolios, based on BE to ME, we see that the middle portfolios are grouped together, and the extreme portfolios are not. But for the investment-based portfolios, the extreme portfolios are grouped together. So the cost of getting a slightly better out-of-sample performance is that we lose some economic interpretation of what these groups are. And it's not clear why the size, value, and investment portfolios should result in such different groups. So next, to illustrate the usefulness of the DFC model, we'll do an exercise in portfolio optimization. We'll construct mean variance portfolios based on different volatility models. We'll compare these. So to make sure we're all on the same page, I want to take just a couple minutes to set up the mean variance problem. So suppose we have n securities with some expected return vector mu, that's n by 1, and some covariance matrix, sigma t. Both of these can be time varying. Sigma is going to be n by n, as well as some portfolio target return mu 0. Then the classic Markowitz mean variance problem is to minimize the portfolio variance, that's this quadratic form here, with two constraints. The first constraint is that the portfolio weights have to sum to 1 for this to be a legitimate portfolio. And the second constraint is that the portfolio expected returns is at least as high as your target. Now that's a well-defined quadratic programming problem, and there's a closed form solution in this case. If we define A, B, and C as shown here, then the mean variance efficient portfolio, given some target return mu 0, has its weights given by this expression. So it's given by the sum of two terms. And the first term is a function of the global minimum variance portfolio, which we'll come to in a minute. And the second term contains the tangency portfolio, which gives us the ex-ante highest possible Sharpe ratio. And this expression is the classic two-fund separation theorem, that any mean variance efficient portfolio can be written as a combination of two other mean variance efficient portfolios. Now, if we ignore the constraint on the target expected returns, this constraint, then we're trying to find the portfolio with the lowest variance such that the weights sum to 1, ignoring expected returns. And the solution to that is the so-called global minimum variance portfolio, given by this expression here. And we'll construct both mean variance efficient portfolios and the global mean variance portfolio for different volatility models and compare these, in effect, comparing the volatility models. So we'll get these covariance estimates from different volatility models. But to compare the volatility models, we'll keep the same estimates for the mean vector, the mean return vector, mu t, which is simply going to be a rolling average with a window of 60 months. Here we'll use the 49 industry portfolios as basis assets to construct these portfolios. And for the mean variance portfolios, we'll consider three different levels of expected returns at 5%, 7.5%, and 10%. And here are all the volatility models we consider. The first model is simply going to be unconditional covariance estimates. We'll use a 60-month rolling window to estimate the historical covariance matrix. The second model fits a DFC on raw returns without imposing a factor structure on the mean equation. We'll forecast both the time-varying volatility parameter D and the time-varying correlation parameter R. And then our covariance estimate is going to be D times R times D. The third model first fits a CAP-M, or the market model, to raw returns, as well as a Garch model on market returns to capture the time-varying market volatility. And then a DFC on the residual returns. So now the covariance estimate has two parts. The first piece comes from the factor arch term coming from the market, driven by the conditional variance of the market. And the second piece comes from the DFC model. The fourth model is similar to the third one, but now fits a Fama-French three-factor model instead of a market model, as well as Garch on these factors, and then the DFC on the residual returns. So our conditional covariance estimate is similar, but now the factor arch term is now a function of all three factors instead of just the markets. Models 5 through 7 also first fit the Fama-French three-factor model, but then we'll impose group DFCs on the residual returns based on French's industry classification. And the last model is going to be a dynamic equicorrelation model that imposes there's only one group for the group DFC. So the first metric by which we compare these portfolios is the out-of-sample portfolio volatility. And here's a table of the out-of-sample portfolio volatility in percentages. And we'll have 8 different models, as well as the 4 portfolios, the global mean variance portfolio, as well as the mean variance portfolio for 3 different return targets. When we see that for the unconditional covariance, the portfolio can be somewhat volatile, about 20 to 30% out of sample. Whereas if we impose a DFC model on the data, without imposing any factor structure, we can reduce the portfolio out of sample volatility. And if we impose factor structures on the mean equation, we can further reduce the portfolio volatility. And it turns out this Fama-French 3-factor model with a 30-group DFC results in the lowest out-of-sample volatility across the board for the 4 portfolios. And note that for these mean variance portfolios, the return targets are exactly the same. And this constraint will be binding so that the model that gives you the lowest out-of-sample Sharpe ratio, the lowest out-of-sample portfolio volatility also has the highest out-of-sample Sharpe ratio. And in this case, again, it's the Fama-French 3-factor model with a 30-group DFC. And it turns out the DECO model actually doesn't do as well as the DFC models here. And that's because the increased flexibility from the dynamic factor correlation models outweigh the potential improvement in efficiency coming from DECO. The second metric that we'll consider to compare these portfolios is how variable the portfolio weights are. It's a well-known problem that mean variance portfolios could result in portfolio weights that vary wildly over time. And there are several strands of literature trying to resolve this problem. So we track how the weights change by taking an average across the portfolio constituents, as well as through time, of the absolute change in the portfolio weights. It's essentially a turnover measure. And we see for the unconditional covariance, the portfolio turnover is quite large, sometimes over 200%. But the non-factor DFC cuts that by about half. And as we impose more sophisticated volatility models, we can greatly reduce the portfolio variability. And it turns out in this case, it's the Fama-French 3-factor with a 5-group DFC that has the lowest portfolio turnover. And the DECO model performs similarly to the rest, indicating that the increased efficiency coming from DECO is about on par with the increased flexibility coming from the DFC models. So last piece I want to talk about is relating correlated volatility shocks to asset pricing. In their 2016 paper, Herskovic et al. Demonstrate that this common factor in idiosyncratic volatility, their CIV factor, is priced in the cross-section of stock returns. The CIV factor is constructed as an equal weight average of the individual securities' unexpected idiosyncratic volatility, or variance rather. So if we take the unexpected idiosyncratic vol of a single security, we can rewrite it as a product of a volatility innovation term and a time-varying volatility term. So if we take averages on both sides, we of course get the CIV factor back, but through a first-order Taylor expansion, we can show that the CIV factor is approximately the sum of 3 terms. The first term doesn't vary over time, and the second and third terms do. And the second term is going to be a weighted average of individual securities' volatility innovations. And that term is going to capture the commonality in volatility shocks. So it's what we've been talking about all along. This is the correlated volatility shocks factor. And we'll call it VIN for volatility innovations. And the second term that varies over time is going to be a weighted average of individual securities' time-varying volatility. So it's going to capture the commonality in time-varying volatility in the cross-section. And we'll call it TVV for time-varying volatility factor. So it's this relationship between CIV, correlated volatility shocks, VIN, and time-varying volatility, TVV, that we'll exploit for asset pricing tests. First, let's just form portfolios based on individual securities factor loadings on these 2 factors. We'll estimate loadings, or betas, if you will, on these 2 factors using 60-month rolling windows. And we'll further lag these betas 1 month when we form the portfolios to ensure that these are observable. On the top panel here are 5 portfolios formed using individual security sensitivities to correlated volatility shocks. And we see that there's a healthy spread in average returns, resulting in about a 3.3% spread. But in fact, the high VIN beta portfolio, these securities, have lower returns compared to the low VIN beta securities. So that may seem a little strange, but the intuition is that these high VIN beta securities pay off well in states of the world in which you get these correlated volatility shocks. These are undesirable, and these are high marginal utility states of the world that investors want to insure against. So that these high VIN beta securities essentially are insuring against these bad states. Therefore, if you're selling insurance, you get a negative compensation for it. So if you buy insurance. The opposite is true. For the low VIN beta securities, these pay off poorly in these high marginal utility states. Therefore, these are risky and earn higher average returns. On the bottom panel here are 5 portfolios based on these time-varying volatility factor betas. And we see a similar pattern that there's average return spread. Now it's considerably smaller at 1.6% per year, though half as large. And the intuition is similar but not identical in that the high VIM TVV beta securities are these securities that pay off well in states of the economy that the level of volatility is high, and which means the investment opportunity set going forward is poor for investors. These are also states that investors don't like and try to hedge against. And this is essentially your hedge, this portfolio. We'll also form double-sorted portfolios based on both VIN and TVV beta. So we'll take the entire cross-section, form 5 portfolios based on VIN betas, and 5 independent portfolios based on these TVV betas, cross the two, and get 25 portfolios. And we see an average return spread across both dimensions, indicating that neither is subsumed by the other in the cross-section. And we'll also construct an investment strategy by taking a long position in the portfolio with the largest betas, both in VIN and TVV, and short position in the portfolio with the smallest betas. This strategy gives you a return of minus 8%. Of course, you can reverse this to get a positive 8%. And the magnitude here is similar to the finding in Herskovic et al. For their CIV factor, they find that we see an average return spread of minus 5.4% in the cross-section. And recall that their CIV factor is a combination of VIN and TVV. So here, when we do a finer sort based on both of these and form 25 portfolios, we'll get a somewhat larger average return spread. If we try to adjust the average returns here using the CAPM, the Fama-French 3-factor model, or the Carhart 4-factor model, we see that the average returns actually becomes larger. The spread actually becomes larger. Although these factor models do explain time series variation as indicated by the higher R squareds. And the fact that the average returns can't be explained is because this portfolio has a positive market beta, a size tilt, and a momentum tilt, but a growth tilt. We'll also form double-sorted portfolios based on VIN beta and market equity. And we see that for each size quintile here, we get a negative average return spread, consistent with the univariate sort, where we saw a negative average return spread. But we see that the effect of correlated volatility shocks is really the largest among small securities. You get in the smaller size quintile, you get a large return spread of 5.3%, and that quickly dwindles as you get to larger securities. We do the same thing for time-varying volatility factor betas, and we also see a negative average return spread in each size quintile. But in this case, it's even more obvious that the effect is concentrated among small securities. This finding is consistent with the Herskovic et al. Finding that their CIV factor also works the strongest among smaller securities, so that when we combine both TVV and VIN, that effect remains. So to sum up, I showed you that correlated volatility shocks contribute to the co-movement in idiosyncratic vol. And to capture that, we proposed this dynamic factor correlation model to directly model these correlated volatility shocks so that we're able to fit the data better compared to DCC and DECO. DFC is also closely related to Boleslaw's constant conditional correlation model and Engel and Kelly's dynamic equicorrelation model under certain restrictions. And I showed you that the DFC model can potentially be used to build more stable mean variance portfolios. This common factor in idiosyncratic vol in Herskovic et al. Can be decomposed into a correlated volatility shocks factor, VIN, and a time-varying volatility factor, TVV. And we see that VIN is priced in the cross-section, but TVV really isn't. So thanks very much, and I'd be happy to take any questions. I'm talking about this factor here. So here you first fit the Fama-French three-factor model, you get some residuals, and then what you need to fit on these residuals, typically, this is like your DCC model, right? You fit on this thing. Instead of fitting a DCC, I'll fit this thing. And here's the common factor in idiosyncratic volatility shocks that we'll use. So we'll take the square of the standardized residuals, average them, to give you the time-varying variance of this common factor. And then we'll use quasi-maximum likelihood to get these factor loadings on the common factor in volatility shocks. And I think that's the piece that's missing in DCC and DECO and these other multivariate gauge models. Go ahead.
Thanks for the talk.
Sure, thanks.
You mentioned the correlated shock, so the idiosyncratic volatility that is still sort of common to several different stocks, if I
Right.
understand that correctly. Do you have any way of modeling stocks that are affecting, volatility that's affecting an individual stock based on, so for example, events or things like that that are not correlated at all?
Sure. So, what modern finance tells us, right, is that when you form a portfolio, these tend to get diversified out, so that it's not the first order thing to model is really the portfolio volatility, and that's what we're trying to get at here. So it doesn't really capture, it's outside of my model to capture individual variation. Okay. So the point here is that we have all these volatility models to capture the stuff that can't be diversified. But actually, there's an additional component that can't be diversified in the idiosyncratic volatility shocks.
Because they're correlated.
Exactly. Right. So when you form a portfolio, these don't go away. Right. You actually hit a bound in which how much you can diversify.
Right. So you're saying a single stock volatility is less interesting because you could.
It's interesting, but if you form a portfolio, these tend to wash out.
At the level, it's sort of not very crucial.
It won't be the most important piece. Right.
Right. Got it. Thanks.
Sure.
And the cross-sectional correlation exists over different periods.
Yep. So the data is from 1946 to 2015.
But like if you test different sub-periods,
I believe so. Yeah. So we can.
just test the whole period, or do you?
No, I've split it in half, in thirds, and it's there.
Like even, or if you do shorter periods, like.
Sure. I didn't do that in this paper. So is your question about the commonality in idiosyncratic vol or the shocks themselves?
My question is about the cross-sectional correlation that you've observed.
Sure. So
That's
for
residual to the.
yeah. So if it's about idiosyncratic vol, this was that Herskovic paper. So that's why I didn't do that. But they've done much finer windows, and they find the same thing. So we've only replicated a part of that because that's already a published paper. But the vol shocks, we've done halves and thirds, but not finer than that. But I can certainly check. Thanks.
Also, do you mind just briefly defining what is the definition of the idiosyncratic vol? Maybe it's a
Sure.
standard
Bless you.
but-
Let's see. Idiosyncratic vol is essentially the vol of these guys, right? So when we think about portfolio vol, that's the left-hand side, all right? So when you form a portfolio with the returns, that's your portfolio volatility. That's driven by common factors, so something like the market, right, soaks up a lot of variation. But once you take out the market, these guys, the residuals from if you run just from a market model, the residuals are by construction uncorrelated. But what's interesting is that the volatility of the residuals are actually strongly correlated. So if you just square these residuals and you look at the correlation of these, you see a factor structure. And it doesn't.
Like unconnected stuff.
So in the entire cross section, which maybe you don't expect to see, right? So you can even take principal components for the mean returns, try to soak up as much variation as you can for the R's, and then you get, of course, these guys are uncorrelated, but the square of these guys are still correlated. So again, that's the Herskovic paper. So I didn't talk too much about that.
Thanks for
Sure. Question?
Last one.
Last one. Okay, please. Sure. So. Sure, so it's probably clear that my background is stronger in Garch than stochastic vol. You can certainly model this with stochastic vol. I didn't explore this, but that would be an interesting thing to look at. Okay, thanks very much.
Thanks a lot, everyone.